Is it possible to reliably and consistently predict short-term stock price movement? In this video, you're going to find out. Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in this video, I'm going to show you some research that I did a little while ago that is going to prove that it is virtually impossible to accurately and reliably predict short-term stock prices. Now, as always, before we get started here, for those of you who just came across my channel for the first time, I want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so the first thing that you must understand just on a very high level before I show you this research is you must have some understanding of the bell curve, or also referred to as the normal distribution curve. Now, you could definitely take an entire class just going into the bell curve and what it does and how it works, but in this video, I'll just keep it very simple. This curve, this graph, simply allows you to model random systems, like flipping a coin or rolling a pair of dice. So for example, let's say I wanted to flip a coin 100 times, and those 100 coin flips is considered my first trial. And as I'm flipping that coin, I'm going to keep track of how many heads and how many tails come up on that coin. So for that first 100 flips, I might get 52 heads and 48 tails. And then for my second trial, my second round of flipping that coin 100 times, I might get, let's say, 46 heads and 54 tails. And then I just repeat that process over and over and over again until I've done maybe 1,000 trials, right? So in order to accurately apply this bell curve concept, you do need a lot of occurrences, a lot of flips of the coin, a lot of rolls of a pair of dice, or a lot of stock market data. And so for this coin flipping experiment, after I've done my 1,000 trials, I then take the number of heads I got from each trial, 53, 47, 60, etc., and then I just plot them on a graph. And what you'll find, and this is the very cool thing, is when you are finished plotting all those data points on your graph, what you will see is a near perfect bell curve. And I actually conducted this experiment myself. I basically wrote some computer code so that my computer would actually simulate all these 1,000 trials for me. I certainly could just sit here and flip a coin 100,000 times in total, but I definitely have better things to do with my time. So I'm going to show you the outcome of that experiment very quickly, just to give you some better context and understanding of how all this research is going to work. But ultimately here, simply stated, if you are able to take a series of events like flipping a coin or rolling a pair of dice or analyzing day-to-day stock price fluctuations, and as you graph the outcome of those events onto a chart, if the graph you get looks a lot like the bell curve, then what you are modeling are random events. And there is no way to gain an edge in trying to accurately and consistently predict the outcomes of random events. You can sit there and flip a coin all day long trying to predict heads or tails, but in the end, you're going to come out right half the time, 50-50. Same thing with rolling a pair of dice. There is just no way to try and consistently predict which numbers are going to end up on top after you roll the dice, because it's a totally random outcome. And the stock market is virtually the same exact kind of thing. It's not a perfectly random system like flipping a coin or rolling a pair of dice, but it's very, very close. And so with all that being said, let's jump on over to my computer now and we'll take a deeper look. Okay, so very quickly here, I'm going to show you that coin flipping simulation I did with my computer just to help solidify your understanding of all this stuff. So as I explained, my computer simulated 1,000 trials, right? If I scroll all the way down here, you would see all 1,000 iterations of flipping a coin 100 times. So you can see in the first trial, my computer simulated 100 coin flips and we got 51 heads, which of course also means we got 49 tails. And then for the second trial, the second round of flipping that coin 100 times, we got 53 heads, and so on and so forth. Now over here, in these columns, I've basically transformed this data to help me better plot it onto a graph. So basically the way you read this table is the number of trials that gave 31 heads was 2. There were only 2 trials out of the 1,000 we did, where the number of heads that came up was 31. And this should hopefully be a little bit intuitive because when you think about it, flipping a coin has a 50-50 outcome. So in theory, you should get 50 heads and 50 tails. Now, of course, that is probability theory. That does not always play out in reality. So, of course, you can flip a coin 100 times and still get 31 heads, but that's going to be a very rare occurrence, which is why we only saw this outcome 2 times out of the 1,000 trials. But in the case of getting 49 heads, very close to 50, 782 trials gave exactly 49 heads, which makes a lot more sense. Because again, in theory, it should be 50-50. And so finally, when you take this data here and you plot it onto a graph, let's come over here, this is what you get. So as you can see, after plotting the data points onto this chart, what we got is a near perfect bell curve. And the way you interpret this graph is on the x-axis, this is the number of heads, and then on the y-axis, this is the number of trials that gave the specific number of heads. So in the case of getting exactly 50 heads and 50 tails, the majority of our trials gave exactly that result, right? Of the 1,000 trials I did, or that my computer did, about 850 of them gave exactly 50 heads and 50 tails. And then for the trials where we got a different number, either less than 50 heads or more than 50 heads, of course, those events will happen, but they will happen with much less frequency. So in the case of getting 67 heads or so, there were only about 1 or 2, maybe 3 trials where this outcome actually happened. Very rare. So I hope at this point you have a pretty good understanding of the bell curve and how it can be used to model and prove that a system is indeed random. And now we're going to apply this to the stock market. So let's come over here. And as you can see, I've downloaded a lot of SPY data. And in case you don't know, SPY is just an ETF that tracks the S&P 500. So it basically reflects the overall US stock market, or at least a very large bulk of it. And I pulled this data from Yahoo Finance, and specifically I pulled daily price movement for SPY starting on September 5th of the year 2000 all the way to 2021. And Yahoo Finance does give you a lot of detailed data, like the opening price for this day, what was the price of SPY when the market opened, you get the high of the day, the low of the day, the closing price, the adjusted closing price, and then the return is what I actually calculated by hand. Or at least I used Excel to calculate these numbers for me. So for example, you can see the return, and I used the adjusted closing price to do this. The return from September 5th to September 6th, just one day, was that SPY dropped by 1.14%. The price fell from 103.44 down to 102.26. And so again, that's a drop of 1.14%. And then from September 6th to September 7th, SPY gained in price by 0.86%, and so on and so forth. So this is the data I'll be using for my research, or that I did use for my research. And then scrolling over here, in this table, I did some basic transformations of that SPY data to get it into the format that I needed for this research. So basically, it's a very similar process to what I did in this table here, basically just preparing the data to then graph it. Let's come back. And so then from this data, I then put it onto a chart. And so now finally, let's look at that chart. Coming over here, and here we go. Now in this one, there's actually 2 different graphs. The dots in blue represent the actual SPY data, and the dots in orange show you the theoretically perfect bell curve, right? Because again, the bell curve is just a theoretical model, and so I wanted to see how the actual data in blue here held up against the theoretically perfect bell curve. And as you can see here, the actual data resembles the bell curve very, very closely. And so the way you interpret this graph is on the x-axis down here. These are the daily price returns, all the way up to positive 10%, down to negative 10%. And then on the y-axis, this shows you the percentage of the time where these returns actually occurred. So for example, all the way up here, there's one tiny blue dot, hard to see, but the majority of the time, I would say around 46 to 47% of the time, SPY moved up by just a very, very tiny amount, maybe 0.5%. And then the big moves, either to the upside or the downside, of course, do happen, but they happen with much less frequency, just like with the coin flips, right? SPY drops 4% in one day, only about 1% of the time. It's a very rare occurrence. Now there's a lot more analysis I could go into about all this data here and about these charts, and I actually put together a full-fledged Skillshare course that goes into all this research in very great detail. And the link to that course is in the description below. It's called Options Trading, Understanding Stock Market Behavior. So definitely check that out if you're interested. Now, finally, the last thing I want to show you here is what happens if I apply this exact same kind of analysis to individual stocks, right? Because SPY is a broad market ETF. It's the S&P 500. But what about individual stock prices? And what you'll find if I scroll up here, and this one is for Goldman Sachs, again, what you'll find is the exact same thing. Here in blue is the actual Goldman Sachs stock price data, and then in orange is the theoretically perfect bell curve model. They're not identical, of course, but they are very, very similar. Scrolling up again, here we have Disney, and once more, same exact thing. Disney stock prices follow the normal distribution pattern. And one more, I also did the same thing for Apple, and voila, same thing. So ultimately, this means, as I mentioned earlier in this video, because stock prices can be modeled very closely to the theoretically perfect bell curve, that means stock price fluctuations in the short term on a day-to-day basis are very close to being perfectly random. And as a result of that, it is virtually impossible to gain an edge to reliably and consistently predict where stock prices are going to go in the short term. And I do want to emphasize here that I say virtually impossible, not completely impossible. If stock price data did follow exactly the bell curve, then yes, it would be impossible. But because there is a slight difference in these curves, it is virtually impossible or almost impossible. There are only a very few select stock traders who can actually, in the long term, generate consistent profits on average by trying to predict short-term stock price fluctuations or movements. And even when you look at the win rates of some of the best stock traders in the world, and by win rate, I'm referring to the percentage of the time where they actually make a trade and generate a profit, you'll see that their win rates are very close to 50%. Again, because the chance that a stock is going to go up in price or down in price on any given day is basically the same as a flip of a coin. It's extremely close to 50-50. So I hope you found this research to be interesting. And again, definitely check out my Skillshare course if you want to see this stuff on a much more in-depth level. There's a lot more I can talk about on this topic. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out those Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.